quick conversation about estates and gift taxes. How do they work? So we are trying to understand federal estate and gift taxes this year. Don't you go anywhere. You're going to love today's conversation. I guarantee it.
One in a million, one in a million, one in a million. You know they're coming up to me, cause I'm just the kind of flower that's stinging from the beat, but the rhythm's getting higher. Go, 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 go. One in a million, one in a million, one in a million, one in a million, one in a million.
Welcome back, folks, to another edition of the Awesome Sorty Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I want to speak to you about estate and gift taxes. And let's first start with estate tax. So the federal estate tax applies to the transfer of property at death. So the gift tax applies to transfers made while a person is living. And the generation skipping transfer tax is an additional tax on a transfer of property that skips a generation. So it's really important to have a clear foundation of the topics we are going to discuss today. So how does the estate tax work? Well, the total tax due is calculated by adding up the fair market values of all the decedents, all the deceased, the person who died, assets as of the date of the death. So the assets that are part of your estate can include cash, stock, bonds, and other securities, business interest, real property, trust and annuities, insurance, and other valuable assets. Very important, okay? So the estates of all U.S. citizens and U.S. residents at the time of death are subject to the federal estate tax. But very few estates actually have to pay because there is an exemption, okay? Only estates whose values exceed the exemption after deductions are made and credits are taken are subject to the federal estate tax on the balance. In other words, you have to be rich. You know, it's rich people. So you have something called the unlimited marital deduction. So what is the marital deduction, the unlimited? So one of the most significant deductions for the estate tax of a married deceased is the unlimited marital deduction. So remember, the estate tax is based on an estate's value after all available deductions and credits have whittled it down. So in general, the marital deduction allows a deceased to take a deduction for all property in the gross estate transferred to the surviving spouse at death. Okay, so this is really important to understand. So generally speaking, the IRS does not allow the marital deduction if the surviving spouse is not a U.S. citizen, because again, this deduction will actually whittle down the amount of the estate. So you got to be a U.S. citizen, and you know, if that surviving spouse is not a U.S. citizen, there are other rules, but they don't get the full marital deduction. And we have to understand, to really clarify things a little further, you have to understand something called estate tax portability. So what makes the estate tax portable? So the Internal Revenue Code also provides a portability of the estate tax exemption between married couples. So portability means that if you are married and die before your spouse, you can pass any of your unused exemption to them to use for their own estates. For example, if your father left an estate worth $10 million when he passed away this year, he still had $1.7 million left after applying this year's exemption of, let's say, 11.7 million. So if your father was married at the time of his death, he can pass that remaining $1.7 million from his estate to his spouse. Now, your father's spouse can shelter the $1.7 million more than whatever the estate tax exemption is at the time of her death. Okay, so a federal estate tax return must be filed if the executor of the estate wants to give the portability bump to the surviving spouse, even if the deceased estate does not owe a tax before its value does not because its value does not exceed the exemption amount. So this is really important to really clarify things. And so If you have to file an estate tax return, you need to file Form 706. When a gross estates exceed the federal state tax exemption for the year of the deceased's death. And Form 706 must be filed with the IRS within 9 months of the deceased's date of death. And an automatic extension can be applied for by using Form 4768. Very important. So one thing I want to say here is that the federal government does not impose an inheritance tax, but 6 states do as of this year. So we have Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania. Okay, only the part of the estate that is over the federal exemption is taxed. So this year, in 2022, for example, the exemption limit is 12.06 million. And estate tax rates range from 18% to 40%. In most cases, your estate is not subject to tax if it's inherited by a spouse. An estate tax is paid by the estate on assets over a certain amount, and inheritance tax is paid by the beneficiary on certain inherited assets. Okay, so 12 states have an estate tax. So you have Washington, state of Washington, Oregon, Hawaii, Minnesota, Illinois, Vermont, Maine, Connecticut, Massachusetts, Rhode Island, New York, and Maryland. The District of Columbia also imposes an estate tax. Okay, and the thing is, if you want to reduce your estate taxes, you just have to, you can give away. So giving away assets before your death reduces the size of your estate tax burden, as long as you care about the federal gift tax rules. Very important. You can also leave bequests to charity. If you leave your estate to your spouse, you can avoid estate taxes. Let's talk about gift tax. So what is the gift tax really? So the gift tax is a tax that individuals must pay when they transfer a gift to another individual. So the IRS defines a gift as a transfer of property from one individual to another, where the giver does not receive payments for the full market value. So the gift could be money, but it could also be other assets such as stock or real estate. So this is really important. So who actually pays the gift tax? Generally, you don't have to worry about paying any taxes on gifts you received from loved ones. It's the giver of a gift, not the receiver, who would file a gift tax return, and this is Form 709, and potentially pay the gift tax. In most cases, it's pretty clear when a gift is being made anytime you transfer something of value from one person to another. So, but there are some situations where someone might be transferring a gift without truly thinking of it as a gift. Okay, for example, if you are giving a gift to your child, that is a taxable exchange. The only individual you can actually give a gift to without potential tax consequences is your spouse. Something could also be considered a gift even if there is a partial payment made by the receiver. Suppose that a couple decided to sell their home to their adult child for a price of $250,000, but the fair market value of the home is actually $500,000. So you are speaking about $250,000 received, where the fair market value is $500,000. So even though their child paid them the $250,000 difference, even though even though he paid them the $250,000 difference between the purchase price and the market value is considered a gift for tax purposes. Okay, so this is important. So the good news is that there are plenty of gifts that will not be subject to the gift tax. So you have tuition or medical expenses paid on someone else's behalf, gift to your spouse, gift to a political organization, gift to a charitable organization. And there are annual exclusions and lifetime limits. So we need to really be careful about that. So thanks to annual and lifetime exclusions, most individuals will never actually end up paying the gift tax, and many will not have to file a gift tax return for the property they transfer to others. Okay, so the gift tax, the annual exclusion is $16,000 this year, $16,000. So it goes up depending on inflation. I want to talk to you about something called a lifetime exemption. This is really important when we analyze the gift tax. So, filing a gift tax return does not mean you will actually end up paying gift taxes, as the IRS also has a lifetime exemption for the total amount someone may gift actually throughout their lifetime before they pay gift taxes. The lifetime exemption is $11.7 million for this year. Okay, actually it will go to $12.06 million this year. Actually, it was last year. Okay, so for example, if you gifted someone 20 grand, you would have to file a gift tax return for 5,000, the amount over the annual exclusion. However, the 5,000 will then also count towards your lifetime exclusion. So if you haven't used it up yet, you may not have to pay taxes on that money at that point. Okay, so this is really important to understand. And one thing you also have to clarify here is that large gifts transferred during your lifetime may also have tax implications after your death. So estates that exceed a certain amount are subject to the estate tax before they can be transferred to beneficiaries. But the gift tax exclusion and estate tax exclusion are interconnected. Very important. So the thing is, so the gift tax for this year, as I said before, this year you have to actually make sure that it's 18%. So it goes from 18% to 40%, and the limit is 1 million. Okay, this is important. So I just want to clarify things here. The takeaway here is that the gift tax is a tax on the transfer of valuable assets from one person to another. The tax rate ranges from 18% to 40%, depending on the value of the taxable gift. Gift givers may be subject to the gift tax anytime that they transfer something for less than full market value to someone other than their spouse, a hospital or school, on someone else's behalf, a political organization, or a charitable organization. So this is kind of important. And there is a gift tax because Congress wants to prevent wealthy families from avoiding estate taxes by giving assets to their loved ones during their lifetime. So this is why they have it there, okay? And so if you're not really wealthy, you shouldn't really be worried about the gift tax, okay? Even though this could also apply to you, but it's mostly for wealthy families. Let's talk about the inheritance tax. So, an estate tax is applied to an estate before the assets are given to beneficiaries, right? In contrast, an inheritance tax applies to assets after they have been inherited and are paid by the inheritor. So, how does it work? There is no federal inheritance tax. However, only select states, you are speaking about Iowa, Kentucky, Maryland, Nebraska, New Jersey, and Pennsylvania, still have their own inheritance taxes. Maryland alone has both an estate and an inheritance tax. Okay, so that tax is assessed by the state in which the inheritor is living. Whether your inheritance will be taxed and at what rate depends on its value, your relationship to the person who passed away, and the prevailing rules and rates where you live. And as with estate tax, an inheritance tax is due. If it's due, it's applied only on the sum that exceeds the exemption. So above these thresholds, the tax is usually assessed on a sliding basis. It goes down. Okay, so rates typically begin in the single digits and rise to between 15% and 19%. But the thing is, what I'm trying to say, the higher the amount, the higher the rate, but the lower the amount, the lower the rate. Okay, so the exemption you receive and the rate you are charged may vary by your relationship again to the deceased. Okay, there are some exceptions that we need to really clarify here. Life insurance payable to a named beneficiary is not typically subject to an inheritance tax. So although life insurance payable to the deceased person or their estate is usually subject to an estate tax. As a rule, the closer your relationship to the deceased, the lower the rate you will pay. Surviving spouses are exempt from inheritance tax in all 6 states. Domestic partners too are exempt in New Jersey. Okay, descendants pay no inheritance tax except in Nebraska and Pennsylvania. Okay, so let's just show you the jurisdiction, the states with the inheritance tax. So here are the jurisdictions that have this kind of tax with their threshold minimums shown in parentheses. So you're going to see on the screen here. So we have Iowa, $25,000. Kentucky, $500 to $1,000. Maryland, we have $50,000 to $100,000. You can see this on the screen. Nebraska, 10 grand to 40 grand. New Jersey, none to $25,000. Pennsylvania, none to $3,500. Okay, so because the rates for estate tax can be quite high, careful estate planning is advisable for individuals who have estates worth millions of dollars that they want to leave to heirs or other beneficiaries. Let me quickly talk about the correlation between estate tax and gift tax. Since estate taxes are levied on an individual's asset and estate after death, they can be avoided if you gift assets before you die. However, the federal gift tax applies to assets that are given away in excess of certain limits while the taxpayer is living. And according to the IRS, the gift tax applies whether the donor meant the transfer as a gift or not. And so let's talk about the gift tax exclusion. However, the IRS offers very generous gift exclusions. So for this year, the annual exclusion is $16,000 for 2022. Okay, and they may offer gifts up to the value of the gift exclusion year after year without incurring tax at all. Okay, so these provisions make gifting an effective way to avoid tax on assets transferred to people such as non-family members who might be subject to the estate tax if the assets were transferred as part of an estate. So let's talk about the gift exclusion limits. So if your gifts exclude, let's say if your gifts exceed the gift exclusion limit, they are not subject to tax immediately and may never be taxed unless your estate is really substantial. So the amount above the gift limit is noted and added to the taxable value of your estate when calculating estate tax after you die. Okay, let me give you an example because I really want to break this down for everybody to understand. So for example, let's say you decide to make a gift of $76,000 in 2022. Since the annual exclusion is $16,000, you will be spared tax up to that number. So the remaining $60,000, however, will need to be reported on a 709 gift tax return. That 60 grand will reduce your lifetime exclusion to 12 million and also your estate tax exclusion to 12 million. Okay, so this is really what it is. I mean, unfortunately, the estate tax is sometimes referred to pejoratively as a death tax since it is levied on the asset of a deceased individual. But listen, it is what it is. You can't change people. But yeah, so I just wanted to give you the correlation. I just wanted to clarify the correlation between estate tax and gift tax. I'll be right back right after this. Don't go anywhere.
Finest, yeah, Mr. Killer, and call me señorita. I got me dreaming, my legs up on the ceiling. Oh yeah. I know when he come, he ain't never gonna leave now. Hit it the night run, and that's the way I wanna be. So don't think I'm the one to won't ever be enough.
Welcome back, folks, to another session of the Awesome Sorty Kiwi Show. We are still having a conversation about estate tax and gift tax, and we just wanted to I want to share with you something very important right now, useful info. So the thing is, a lot of our viewers have sent via email. They've sent us email questions via email asking about, will my estate have to pay federal estate tax after I die? The question is, most of them no. Most estates, more than 99.9%, do not. The federal government imposes estate tax at your death only if your taxable income, your taxable estate is worth more than $12.06 million for deaths in 2022. So think about that. So for the vast majority of Americans, there is no estate tax. And married couples, married spouses can combine that amount so that they share an exemption of $24.12 million. Again, one thing you need to understand is that assets left to a surviving spouse, as long as they are the spouse, they are a U.S. citizen. In other words, the surviving spouse is a U.S. citizen. Those assets pass free of estate tax, no matter what the value. And so the federal estate and gift tax rate for deaths in 2022 is 40%. Okay, and so there are ways to actually avoid federal estate taxes. There are ways, yes. legal ways, of course. So here are the most popular ones. You have tax-free gifts. You can give up to $16,000 per calendar year, at least for this year, for recipients without paying gift tax. You can also pay someone's tuition or medical bills or give to a charity without paying gift tax on the amount. So this reduces the size of your estate and the eventual estate tax bill. You can also have an AB trust where spouses leave their property in trust for their children but give the surviving spouse the right to use it for life. So this keeps the second spouse's taxable estate half the size it would be if the property were left entirely to the surviving spouse. However, with the 12.06 million personal exemptions and portability for spouses, AB trusts are unnecessary for most couples. You also have a Q-tip trust, which enables couples to postpone estate taxes until the second spouse dies. However, with the current very high personal exemption and portability of exemptions for spouses, this type of trust is also often unnecessary. You also have charitable trust, which involve making a sizable gift to a tax-exempt charity. You have a life insurance trust, which lets you take the value of the life insurance proceeds out of your estates. Now, let's just close today's conversation by talking a little bit about proactive planning when we speak about estate planning. Very important to plan, okay? And the thing is that some people have been asking if they can give all of their property away before they die and avoid estate taxes. The thing is, you have to understand, the federal gift and estate tax are really just one tax. The individual exemption amount applies to property you give away during life or leave at your death. In other words, you can transfer either while you are living or at your death up to $12.06 million of property tax-free for debts this year, 2022. This exemption amount rises each year because it is indexed for inflation. So the thing you need to understand here is that most gifts are tax-free, which means they don't count against the personal exemption amount. Only gifts are more than $16,000 in 2022 this year per year to any person or non-charitable institution are taxable. Making gifts of $16,000 or less, however, can yield substantial estate tax savings if you keep at it for several years. So some gifts are exempt from the gift estate tax no matter what the amount. For example, if your spouse is a U.S. citizen, you can give your spouse an unlimited amount of property free of gift tax. A non-citizen spouse can receive up to $164,000 for this year. Okay, and again, the amount is also an index for inflation. And any property given to a tax-exempt charity avoids federal gift taxes, and money spent directly for someone's medical bills or school tuition is also exempt. Okay, so the thing is, can you avoid paying estate taxes or inheritance taxes? If your state imposes estate taxes or inheritance taxes, there probably is not much you can do, short of moving. Okay. However, if you live in two states, winter here, summer there, fall here, spring there, your inheritors might save money if you can make your legal residence in a state that does not impose these taxes. So this is really important. So when we speak about planning, there are a couple of indicators. There are a couple of things you need to pay attention to so that you come out legally victor, if you want to think of it that way. Thank you so much for your attention. I really appreciate it. In today's conversation, I was just talking to you about estate taxes, gift taxes, inheritance taxes, and I explained what estate tax is, what gift tax is, what inheritance tax is, and I showed you the correlation between estate tax and gift tax, and I gave you some useful info and in terms of helped you in terms of proactive planning to make sure that you do things the proper way and the legal way, of course. Thank you so much. I'll speak to you another time, but until then, remember, stay marvelous.